Have you ever seen an ETF promising double digit income and thought, wow, this could make me rich fast? But what if that high yield is hiding some serious downsides? In this video, we are pulling back the curtain on covered call ETFs, funds that sells options to generate extra cash. We will show you why they are not always the easy income solution they seems to be and help you decide whether they fit in your portfolio. Hi, my name is Mutib Ahmed. I am a chartered financial analyst and a qualified accountant with a decade of investment banking experience, and I make videos to simplify investment and personal finance. So the question is, how does covered call ETF work? Covered call ETFs collect cash by selling call options on the stock they own. That money gets paid out as income, which is why you see yields of 10% or more. However, the bad news is that selling these call options limits the return potential of ETF if the stocks in the ETF actually go up. When you buy covered call ETFs, you are trading away some future growth for immediate cash. Imagine owning a stock that doubles, but because the ETF sold a call option, it has to sell the stock early and misses almost entire stock rally. If you're young and want your investments to grow over many years, ask yourself if giving up that upside makes sense. Definitely high income feels good today, but your goal should be a total return, which is a combination of dividend income and a price appreciation. Just by focusing only on a dividend part, you risk falling behind investors who simply hold their stocks directly. However, it gets worse. Generous payout of covered call ETFs can actually eat away at your investment over time. These ETFs often pay out almost all the option premium and dividends they collect. They reinvest very little, so when the market dips, there is a less money left inside to bounce back. Over the time, this can cause the fund net assets value, also known as NAV, to steadily decline, even though you are receiving a cash amount, even though you are receiving cash. In other words, part of that big distribution might just be your own invested capital being handed back to you. Therefore, before investing, look up the fund's long-term price chart and the total return. Is the share price trending down while distributions are high? That's a sign of NAV erosion. So you have to be cautious. A high yield doesn't always mean you are making money overall. Eroding NAV means you may end up with less capital to grow in the future. It's like eating the seed you were supposed to plant. Your principal shrinks and the future income can't keep up. But there's another problem. Your payouts depend on something you can't control, which is market volatility. Covered call strategies rely on market volatility to set options premium. When the volatility is high, options are expensive and the ETF earns more. But when volatility is low, say the market is calm and steadily rising, premium actually shrinks and the fund incomes also drop. But the worst part is that funds still can't participate fully in market's gain because of the call option it sold. Ask yourself whether you're comfortable with income that fluctuates based on market conditions. These funds may look great during turbulent times, but they often lag in a quiet upward trending market. Build your portfolio knowing that the steady income can dry up when the markets are calm. Relying on volatility for returns makes your income unpredictable. It also means the ETF could underperform when you most want it to outperform in a long bull market. Therefore, even if the volatility stays high, you still have to think about taxes, and that's where things get tricky. The dividend income from selling options is often taxed at higher ordinary income rates rather than at lower capital gains or qualified dividend rates. Some funds use index options and mixed straddle strategy, letting roughly 60% of gains get taxed at long-term capital gains rate. However, many covered call ETF funds that use individual stock options don't qualify, so you could face rates as high as 37%. Also, distributions may include return of capital that creates a bigger tax burden when the ETF is actually sold. If you're considering a covered call ETF, read its tax documents or consult a professional. Holding these funds in tax deferred account like IRA can soften the tax hit. don't assume all yields are taxed the same way. Unexpected tax bills can wipe out the extra income these funds generate. Understanding the tax treatment helps you keep more of what you earn. Yet, even if you can handle taxes, there's another downside. These funds lag when the markets roar upward. Because covered call ETFs sell away some of their upside, they often lag behind simple index funds during strong bull market. As you can see, all the ETF underperform the S&P 500 since their inception. If you're in your 20s and decades away from retirement, your priority should be growth. A broad stock market ETF like VOO may deliver higher total returns over the time. When you reach at a near retirement age, then use covered call strategies to receive cash flows. Missing out on compounding gains today can lead to a much smaller nest egg tomorrow. High income now could cost you far more later. However, it's not just performance, there are also cost and trading concerns you might not realize. Some covered call ETFs trade infrequently or invest in niche sectors. Low trading volume can lead to wide bid-ask spread, meaning you may pay more to buy and get less when you sell. In times of market stress, price can deviate significantly from fund's actual value. Pro tip: before buying, check the ETF's average trading volume and the size of its bid-ask spread. Stick to more liquid funds to minimize hidden costs. If you can't trade efficiently, your returns will suffer. Even a small slippage can erode returns over time. High yield can't compensate if you lose money simply by entering or exiting the position. High yield can't compensate if you lose money simply by entering or exiting the position. Now, let's look at argument that covered call strategies protect you on the downside. A covered call strategy gives up upside but does not fully protect against downside. As you can see that during 2022, when the S&P 500 lost 18%, covered call ETFs did decline but lower than S&P 500. So you should not assume that covered call ETFs will cushion major market drops. While the premium provides some buffer, you are still exposed to a big decline. Covered call ETFs promises high income, but they carry trade-offs that many young investors overlook. They limit growth, erode NAV, depend on volatility, complicate tax, underperform in bull market, have liquidity issue, and do not eliminate the downside risk. For retirees or investors who prioritize consistent cash flow and can handle these risks, they may have a place in a diversified income strategy. But for most 20-somethings seeking long-term growth, a low-cost, broad market ETF and a plan to reinvestment dividends could serve you better.